The common questions I get, and this one I hear a lot from people, they'll say things like, my brother got a big refund, but I owe. Why? Or I always have to pay. How come I never get refunds? Or another one I get is, I don't even make that much. Why do I owe money still? And this might be a question that some of you folks also have. You might be thinking to yourself that this is something I've asked myself recently. And so we're going to talk about this, and also when it comes to big refunds, why that's also happening. So how does all work? So we're going to bring in now the circle of taxes, right? Here is the life cycle of tax and how the money works. And so some of these topics you can see we've got videos on already about, and we've discussed this stuff in more detail. We're not going to cover the details here on all these items, but look for those videos that we've already discussed. But to start off, we have over here our adjusted gross income. This is all your income that's accounted for. This counts your gains, your losses. This is what we call AGI. This is all the money you've received for the year. From there, we look at deductions. Deductions are subtracted from your AGI. This is the standard or itemized. We have a great video about this you can go learn more about. We also have then our taxes and credits, okay? This is where we look at the tax brackets, we determine the taxes, and then we apply things like credits to those taxes. We then have payments. Payments is money that's paid to the IRS, and that comes through quarterly payments or paycheck withholdings. There's many ways this can come about, but these are the payments that have already been sent on your behalf towards your taxes. Then we get to the very end over here at the very far right. This is your refund or balance that's owed. This is what's left over after credits and payments are already applied. So let's break it down. So refunds. Majority of the time, a refund is simply that. It's your money being refunded back to you. It's not a lottery or a prize you're getting because you did taxes early. It's not that. This is simply money that you are getting back. Majority of the time, it's just from money you overpaid. What is it when you owe? You did not pay enough throughout the year to cover your tax balance, and now you must pay the remainder. That's it. That's really what it comes down to. All right, the good and the bad about refunds. There is good and bad. So the good, you don't owe anything. Nobody wants to owe money at the end of the year, okay? It feels like an extra paycheck. You're getting more money back. And it's great for those folks who don't know how to save very well, right? They're not great at saving. They get money in their pocket. They want to spend it. So this is a great forced savings plan, right? What's the bad? When you get a large, substantial refund, the question you got to ask yourself more about is what could you have done with that money had you had it instead of the IRS? Things like investments you could have been putting that money towards, paying off debt. And a lot of times when you have debt, you're also paying interest. So you're paying debt and interest accrued. That money could have gone towards. Or if you ever faced with an emergency, whether that be a medical emergency or other things that you have at home that are going on, where could that money have gone to had the IRS not had it in their bank? All right, what's the good about owing? So the good, you've all heard about it. Anytime people are not owing money, they think, I didn't give the government an interest-free loan. That's one I hear a lot about people that are having to owe money. The other thing is you get to keep your money to use how you need, whether that's investing, saving, or spending without debt. What's the bad? If you owe too much at the end of the year, you could face penalties. And that's a scary word for a lot of people as they hear penalties. And we're going to talk about that next. Penalties. The thing about taxes is taxes are pay as you go. It's not wait till the end of the year to pay your taxes. It's as you go and as you earn that money. So you need to pay most of your tax during the tax year as you receive income, rather than paying at the end of the year. How much is it? The penalties can vary. And this part is a lot of math that even I don't want to think about it. But the penalty is based on the amount of underpayment, the period when the underpayment was due and underpaid, and then there are actual quarterly interest rates that are published for underpayments, how that works. So the question that everyone's going to ask when it comes to penalties is, how do I avoid it? So there's two key factors here. Number one, owe less than $1,000. If you owe less than $1,000, there's no penalty to worry about. Or, on the other hand, you have to pay at least 90% of the tax shown on the return for the year you're paying taxes, or 100% of tax shown on the return for the prior year, whichever amount is less. Okay? That's how we avoid the penalty. Nobody wants it, so this is what we do to avoid it. All right. So the question then comes to, okay, we know that we have to pay taxes. How are those paid and where does the money come from? There's three main ways that happens. Number one, withholdings. If you work for a company that pays you with a W-2, there's the option to have them withhold money on your paycheck. That can go towards your federal withholdings and pay your federal taxes, but also your state. Withholdings for paychecks, it can come from also things like if you are retired, you receive a pension, or you have your investments you've paid out, you've saved up for, now you're receiving that money back. Or if you receive Social Security, those all have options to have money withheld. You can have withheld and withhold a percentage or even a dollar amount. A lot of my clients are most successful with this. They have their withholdings taken out and add an extra dollar amount of $20 or $30 per paycheck to cover their withholdings. The other option is quarterly payments. This is a way that a lot of businesses pay taxes, or even people that aren't doing withholdings. They want to just pay quarterly if they're retired and want to pay that money on their own. And every quarter, they make a payment towards the IRS. The last way a lot of taxes can be paid is through tax credits. But this is not something that you can always rely on because it can change every year. But some of the most common tax credits are child tax credits. This past year, a child tax credit for any child under the age of 17 was $2,000. Any dependents and child over that was $500. This also comes through things like energy improvements on your home. If you get new doors or windows, you get solar panels, or even through different purchases to improve your home that can cover that and give you tax credits. There are other credits as well that come into play that are out there, but tax credits also can go towards your taxes. All right, things to watch out for. Now, when it comes to our income, and if you're a W-2, we know and have an idea of what we're going to get paid. And so we know what to withhold. But there are other areas that are unpredictable or places that don't have withholdings. So interest and dividends. It can be hard to predict what's going to happen during the year, and this is all considered income that is taxable. I've had lots of clients that come in that have had a successful year with what they've invested in for interest and dividends, and they're getting a big return. But all that money is counted as income, and none of it has withholdings. Okay? Investments. This can be stock, it can be crypto, or even a home that you're selling. And the economy can be a funny thing that swings the value of each of these depending on the situation. It can be counted as income. So, for example, stocks, if you buy stock and then you sell it and you had a gain of, let's say, $1,000, that $1,000 is now taxable income. And without withholdings that are covering, that's going to be taxes that you may not have been planning for at the end of the year. And finally, Schedule C. This can be things, an income you get from a side hustle, contract work you might be providing, or the beginning of a new business you started. It's income that is counted and doesn't withhold anything. Plus, on top of that, you have to look at things like self-employment tax, which is a whole other topic, which we have a video for as well. These are all areas you got to watch out for at the end of the year, because if there's taxes that are applied to this, none of your withholdings are going to cover this unless you withheld extra and accounted for that by the end of the year. So what should you do? That's a great question. And really, when it comes down to it, this is your money. You do what you want. And the questions you should be asking yourself, do you want a big refund? Do you want to owe without a penalty? Or do you want to be close to zero? I got a lot of people that just want to be as close to zero as possible, and they're okay with either owing a little bit or having a slight refund. But they want to keep their money for themselves throughout the year. For folks that just have a hard time saving, they like the big refunds. They go that route. And they like to have a big refund at the end of the year. They can then invest or use it for a family trip or use it for home improvements. Whatever it is that you want to do, it's really up to you. But know how it works and know how to get what you want at the end of the year. And that's the end of our presentation. Thanks for joining us. My name is Devin. Come see me at Pack Tax North Ogden.